Rally into Thanksgiving. We are 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Stocks gain momentum on this Thanksgiving Eve with bullish bets for 2026 starting to flood in.
Adding to that optimism is news that Trump ally Kevin Hassett has emerged as the frontrunner to be the next Fed chair.
And while the AI competition continues to play out, investors turn toward more defensive corners of the equity markets.
So viewers that have been watching Bloomberg TV all day would have seen us earlier and seen us break what I think may be the most interesting, well, it's the only earnings of today, but one of the more interesting earnings of this week, and it was Deere. They issued their first fiscal outlook for 2025, or their outlook for fiscal 2025, but that fell short of expectations. There's a lot of uncertainty about the timing of a recovery in the U.S. farming economy. Matt, those shares falling 4% in the pre-market.
Yeah, I think it's a really fascinating, multifaceted story. We're going to touch on that again in this hour. Checking on Nvidia, which was down more than 14% this month as of the close yesterday, getting a little bit of a reprieve. That's from new competition from Google, concerns around AI valuations, continuing to weigh on investor sentiment. This is another meaty story that we're going to dig into throughout Open Interest today, Dani.
And we're going to start digging into it right now. Wedbush analyst Dan Ives said that he isn't deterred by the Nvidia stock price slipping or talk of an AI bubble.
Nvidia doesn't have enough chips to ultimately meet demand, right, relative to what we see. But it speaks to my point. It's about the second, third, fourth derivatives of AI playing out. You have $3 to $4 trillion that's going to be spent in the next few years. To call this a bubble, it's wrong. Someone like myself that covered tech stocks in the late 90s. It's a 1996 moment, not a 1999 tech bubble moment.
Joining us now is Bloomberg tech reporter Ryan Vlastelica. Ryan, it's not only Dan Ives defending Nvidia. Nvidia itself has gone on the defensive, trying to defend itself against the hype around Google.
Yes, good morning. Thanks for having me. So yeah, there's been a lot of discussion and analysis about what does Nvidia's market share potential look like, especially given the increased attention and focus that's being put on Alphabet's TPU chips. Now, I'll say these aren't exactly a direct sort of comparison to Nvidia's GPU chips. They're much more specific, but they are designed to work on AI cloud workloads, which is what a lot of these chips are being used for. So as Alphabet starts to get these orders, we saw Anthropic, there was a report of Meta earlier this week. People are starting to reassess how dominant is Nvidia going to be. Now, most people do think it's going to be very dominant. It's going to continue to be a major player, but there are very different implications for the stock and the valuation if the market share stays around 80-90% or if it goes down a lot lower.
Ryan, I wonder if it makes a difference to the AI leadership of this market if someone else in the Mag 7 starts to take leadership of, a certain part of the supply chain.
Yeah, what's been a very interesting trade to look at, especially recently, is all the companies that are sort of connected to the Alphabet side of the trade, meaning companies like Broadcom. Those have been doing very well, whereas companies that are more tied to the OpenAI sort of things, which is Nvidia, AMD, Microsoft, Oracle, those stocks have really been struggling this week. So it's been a very interesting sort of disparity amongst those two groups.
All right, Ryan, thanks so much for joining us. This is a story we're going to keep talking about not only throughout the rest of the day, but probably the rest of the decade. Ryan Vlastelica there covers tech stocks for us out of Chicago. Now, on the earnings front, Deere falls after its 2026 outlook comes up well short of expectations. The weak outlook comes as American farmers continue to struggle. Joining us now is Chris Ciolino. He covers the industrials for Bloomberg Intelligence. And Chris, we were expecting a profit of $5.31 billion in 2026, and Deere said it's only going to be between 4 and 4 3/4. Why the big miss?
Yeah, I mean, we expected a conservative outlook heading into the print here. This was well below our expectations and even below, some of the most bearish estimates out there, and really suggests, a more severe and prolonged ag downturn here in North America. To your point, they expect net income to be down north of 10% next year, which would imply earnings somewhere in the $16.50 a share range for 2026, which is 18% below the street. That's the bad news. I think there is a silver lining here. One, this really solidifies that 2026 will be the trough. I think there's little doubt about that now. And two, there's probably some inherent conservatism baked into this outlook, just given the lingering uncertainty on the trade and tariff front.
Well, to that point, President Trump recently had a phone call with President Xi. Soybeans always on the agenda, and not to mention administration that wants to support farmers and might do so with stimulus to them. So, Chris, was this a kitchen sink moment with the government coming to rescue farmers and therefore Deere?
I don't think so. Historically, government aid and farmer aid specifically has not been used to go out and purchase new machinery. They'll use that money to, pay down debt, improve their working capital, cover their living expenses. It's not typically going to new equipment. I do think we are certainly moving in the right direction on the trade front in the agreement with China, but this is still very much going to be a show-me story. I think farmers need to see China in the market and delivering on their commitments, and they really need that stability and predictability before you start seeing farmers go out and invest and replace equipment.
Chris, appreciate it. That's Chris Ciolino of Bloomberg Intelligence as Deere continues to fall in the pre-market. Let's turn now to Washington, where White House National Economic Council Director Kevin Hassett is emerging as the frontrunner to be the next Fed chair, an opportunity he says he would not turn down.
If he were to ask me to be Fed chair, then of course I would have to say yes, because I want to serve my country and I want to serve my president. But we'll see how it goes. There are a lot of great candidates.
Joining us is Bloomberg economist Stuart Paul. Stuart, just judging by the market reaction, bond yields continue to drop lower. There wasn't a crazy sell-off. Didn't seem to be any panic about Fed independence. Is this basically the trial balloon went up and gave the thumbs up for Kevin Hassett?
Look, if this was a trial balloon to see how markets would react to this potentially politically charged nominee heading to the Fed, he passed the test with a resounding A+ grade, with equities moving higher, with the 2-year falling on expectations that the terminal rate could be lower, something closer to 2.75 instead of 3%, and with a 10-year barely budging. You have to think that folks at the White House are very happy with the results that they've seen in the markets over the last 24 hours since they floated the idea that Kevin Hassett would be moving into the chairman spot of the Fed starting in May.
Does the market really care that much about Fed independence? We talk about it all the time, but is it something like, an inflation target that we know we're never going to hit? We're just happy if it's close?
I think that the market does care, maybe not as much as they did over the summer. We actually built an index of how politically charged rhetoric around Fed independence is. And right now, our index indicates that the current rhetoric around the political independence of the Fed is about 10 times more destructive than it has ever been. And when we saw that index really spiking over the summer, we actually did see markets moving. Now that we've moved on a little bit and we're thinking more about deterioration in the labor market, we're thinking about the reshuffling of the Fed with a change in the voters and the board presidents who are going to be taking to the committee next year. I think that attention has turned away from political independence and more towards the business cycle overall. But it does look like it is something that markets do care about, especially when rhetoric gets really hot around the Fed.
There's another criticism of Hassett as Fed chair beyond just the politics of it. And this is a particularly harsh one, to be fair, from Ned Davis Research, Joe Kalish over there, saying that he finds him to be a subpar communicator, a critical skill needed for Fed chair. What would that mean if you have someone? I mean, Jay Powell was the great consensus builder, the one who communicated a very clear direction of where the Fed would be going. What happens when you don't have that anymore?
Well, I mean, we've even seen from Secretary Besson and from Kevin Hassett himself saying that communication policy needs to be dialed in a little bit. So the fact that he might not be the same steady communicator that we've learned to become accustomed to from Chairman Powell might not be so much of a strike against him, especially if the objective is to roll back the extent to which they are providing any sort of forward guidance or any sort of messaging. I think they view that sort of transparency, the reliance on forward guidance, almost as a little bit of a policy mistake. And we've seen it a little bit just in recent weeks. We saw Fed branch presidents coming out very hawkish through October, and that really adjusted pricing for a December rate cut. And then again, we experienced a little bit of whiplash when New York Fed President John Williams came out last week. And now we have about a 90% probability of a rate cut in December priced in. That sort of a whiplash and an attempt to manipulate markets with forward guidance is the sort of thing the administration is looking to move away from. The fact that he doesn't have an A+ in terms of communication probably isn't that big of a strike against him.
All right, Stuart, thanks so much for joining us. Stuart Paul from Bloomberg Economics. We're going to check back in with you in about an hour's time. Let's check in right now on what's going on in the markets. We have futures rising ahead of the opening bell right now, looking at gains of 0.25% on S&P futures, a little bit more on NASDAQ futures. And it's interesting, even with the concern of Nvidia losing out, at least in some sense, to Google, you still see those shares rebounding. That's obviously going to drive the trade today.
Yeah, and you saw yesterday being able to mark gains too, even though Nvidia fell. But I guess you just need something else to take the mantle, like a Google that's done so well over the past few sessions. By the way, some of the other movers on our radar this morning, Dell has raised its shipment projections for the AI server market as it capitalizes on the data center boom, because everything tech is an AI trade.
HP's profit outlook, and by the way, this is an AI story as well.
Of course it is.
Missed estimates for the year as memory chip costs weigh on earnings, but it also, HP that is, announced 4,000 to 6,000 job cuts through fiscal 2028, which is, it's a long way away from
we could have robot overlords by 2028. Who knows what AI will look like?
They're saying that they're cutting these people because they can produce or replace them, I should say, with AI.
Yeah, and again, how would you even make that call right now? Elsewhere, Urban Outfitters posting strong sales last quarter as it leaned into college campaigns with campuses and student athletes, Matt.
Coming up, UK Chancellor Rachel Reeves boosts her fiscal buffer, but an error allowed it to be released early. We're talking about the autumn budget in Great Britain. We head to the big smoke next. This is Bloomberg Open Interest. It's getting out of high interest. Look what's making headlines around the world. U.S. envoy Steve Witkoff is set to travel to Moscow next week for talks with senior Russian officials. This according to the Kremlin. And it's a visit that could include a meeting with Russia's Vladimir Putin if their schedules line up. The trip is part of President Trump's effort to deliver peace after nearly 4 years of Russia's full-scale invasion of Ukraine. Despite the White House's optimism around the negotiations, doubts remain in European capitals, with most of Ukraine's Western allies agreeing that Putin has no interest in an immediate ceasefire. The U.S. just negotiated major Medicare drug price cuts, including a 71% price drop for Ozempic and Wegovy starting in 2027. 15 top drugs will see discounts of up to 85%, saving Medicare an estimated $12 billion and affecting over 5 million patients. Novo Nordisk is still fighting the program as price setting, even as it cuts prices elsewhere to compete with Eli Lilly. Still, the president's goal of cutting drug costs by 1,500% remains elusive. The budget unveil from UK Chancellor Rachel Reeves landed with an unexpected twist today. The fiscal watchdog accidentally posted its analysis before she began speaking. The premature release showed her fiscal cushion jumping to about $29 billion, driven by nearly $38 billion in new taxes. It included higher levies on pricey homes, property income, and savings.
It is my understanding that the Office of Budget Responsibility's Economic and Financial Outlook was released on their website before this statement. This is deeply disappointing and a serious error on their part.
For more on the UK budget, we're joined by Bloomberg's Lizzie Burden, who is live from Westminster. Lizzie, what a messy kickoff to this budget unveiling.
Yep, Rachel Reeves was not happy about that at all. As you heard her there saying it was a serious error. I do wonder whether the boss of the OBR is going to keep his job, Richard Hughes, because of course this was a market-moving, unprecedented move from the OBR. But as you say, the headline that really the market latched onto from that early release was that the headroom of the Chancellor against her fiscal rules has more than doubled to £22 billion. And if you look beyond that, beneath that figure, actually, Dani, the news isn't very good. You've had growth downgraded, the welfare bill still soaring, living standards expected to rise more slowly than expected, and crucially, the tax burden set to become its highest since World War II, when records began. So not a lot of good news apart from that big figure that's actually calmed the market.
It isn't horrible news, though, Lizzie. I mean, the UK economy isn't growing much, but inflation isn't terribly high. Yields are 4.5%, right? The pound is like in the middle range of where it's been over the last few years. Like, why all this incredible drama over the autumn budget?
Matt, was that you actually sort of complimenting the UK there, did I hear? Not the usual take from Matt Miller.
You don't have the debt to GDP of other countries, you know. It just doesn't seem to be as bad. A $20 billion hole, that's what we bet on Argentina.
Let me put to you the lines that are going to last in these markets, okay? The way that she has raised taxes predominantly is a stealth tax rise. She has frozen income tax thresholds, and that is going to drag millions of people into new tax bands. You'll have more higher rate taxpayers. This, according to a very influential economist in the UK, is going to fundamentally change the tax system. And many will be asking whether effectively that breaks her manifesto not to raise income tax. You've got a bit of good news for the left of the party in that she's removed the two-child benefit cap. That would potentially lift hundreds of thousands out of poverty. Crucially for markets, she says that it's going to reduce inflation, and that seems to be another thing that has calmed the gilt market and sterling as well. But I have to say, the big question is it credible to backload the fiscal tightening here? We've got a calm market reaction for now, but if you look at history, Matt, don't judge it by the market reaction right now. Give it a couple of days. And of course, you've got Thanksgiving coming tomorrow. There'll be low liquidity in these bond markets. It could be that the UK is extra exposed to the cross currents across the Atlantic.
It's a very good point. We have a great story on the Bloomberg talking about last autumn's budget. When we thought everything was calm after the speech, then rates started to creep up until gilts hit levels we hadn't seen since the great financial crisis. Lizzie Burden there reporting from Westminster. There's always a guy screaming in the background, which makes it even more dramatic in the United Kingdom. For more on the UK budget, you can head to Live Go on your terminal. Also be sure to check out the T Live for market reaction. Now coming up, Edward Jones's Mona Mahajan joins to discuss her outlook for the markets and if AI can lead us for a fourth year in a row. This is Bloomberg Open Interest.
Both JP Morgan and SocGen increasingly bullish on stocks. Both the analysts at those firms have raised their 2026 year-end forecast. For the S&P 500, JP Morgan is at 7,500, SocGen at 73, and the strategist there at SocGen writing the backdrop is positive for U.S. assets. It's too early to call the bull run over. Let's add another voice to the conversation. It's Mona Mahajan, head of investment strategy at Edward Jones. But I'm having a hard time finding anyone who's not bullish for next year. Deutsche Bank has 8,000 for their price target. Are you all bulled up too heading into the new year?
You know, look, when we think about 2026, it's a benign environment. We're looking at fiscal growth, economic growth that could continue in this 2.5% range. We're looking at moderate fiscal stimulus coming from the tax bill, a Fed that is likely moving interest rates towards neutral. And by the way, the earnings growth picture looks pretty good for next year as well. So hard to see any cracks in the story right now. We know markets can change, they're fluid. But for now, we feel good about where investors are standing.
The consumer is where I would look if I wanted to be dour about these markets. We just found out that 42 million Americans are on food stamps. We know that the subprime auto loan defaults are at the highest level on records going back to the 90s. Consumer confidence yesterday came in at 88 from the Conference Board, far lower than our survey and also much lower than the previous month. So it seems like the consumer situation is worsening.
Yeah, look, I think there is, and we talk about this often, it is a bifurcated consumer. And that lower income consumer is still hurting from years of elevated inflation. They're trying to catch up. Many are working multiple jobs just to keep pace with the bills that they have to pay. Now, all that being said, we have, of course, the middle and upper income consumer that has benefited from stock market growth, that has benefited from potentially home prices stabilizing and moving higher. What we see in the U.S. economy, and what's interesting is economic growth is actually 70 to 80% driven by that middle and upper income consumer. And so when we think about economic growth, it's really does come from those parts of the market, those consumers that are doing relatively okay.
Just given that, and quickly, less than a minute here, can you buy staples? It's been so beaten up partly because of the story.
Yeah. We actually are inclined to buy consumer discretionary because those consumers that do have a little bit of that discretionary income, perhaps they are in the middle and upper income parts of the market, they may start to buy a little bit more. They may start to spend. The bottom part of the market where staples tends to play, they may still be a little bit under pressure. So we like that bifurcation.
All right, Mona, you're going to stick with us through the opening bell. Mona Mahajan from Edward Jones. As futures rise, we're looking at gains on S&P futures, gains on the NASDAQ as well. Gains for Nvidia. The opening bell is up next. This is Bloomberg. We are moments away from this start of trading on Thanksgiving Eve. Looking at gains on S&P and NASDAQ futures, you can see about 1/3% on the benchmark index. The tech index up about 0.5%. Small caps are moving down a little, which is interesting. I'm going to talk to Mona about this because if we expect rate cuts, shouldn't they be benefiting the most? You've got, I think that's Santa Claus in the background.
And some hype elves.
And
really excited elves.
Ringing the bell with Macy's executives on the New York Stock Exchange. I would guess that 99 parades means that's how many they've had so far, with tomorrow being the 99th. So that is interesting, and they're happy because Macy's stock has done well. It's up 34% this year. It's up 134% over the past 5 years. So reason to celebrate for sure. These guys don't look as pumped, but they have much more reason to celebrate. Almonte stock, which is a tungsten company, is up 560% this year to date. It's almost 800% over the last 5 years. So they are crushing it.
It's reason enough to invite Santa over.
Yeah, exactly. He should go from the NYSE. It's a quick train ride up to the NASDAQ market site.
I'm sure Almonte would appreciate a stop by Santa. Meanwhile, Matt, a reason not to celebrate if you own Deere today, issuing its first outlook for fiscal 2025, and that fell short of expectations. So much so shares are down just under 3.5%. It's that uncertainty around the timing of a recovery in the U.S. farm economy that's weighing on them, Matt.
Yeah, that was a shocking headline to see. Such a huge miss in the 2026 profit forecasts. The story of the week, though, has been Nvidia maybe losing a little bit of its luster to Google. TPUs taking over from GPUs. It's down 14% over the last month, except for it's bouncing back a little bit today. You can see it's up 2.5%, I guess for no other reason than the fact that it fell so much. Maybe it's because Jensen Huang said, congratulations to the people over at Google, but we're still better. and this kicks off really a fascinating fight. Mona Mahajan still with us, head of investment strategy at Edward Jones. Does it matter if some of the supply chain leadership changes as long as I'm just selling Nvidia shares to buy Google?
Yeah, look, I think the AI story is going to be with us for several years. I heard Dan Ives on the station earlier saying we're in a 96 era, not the 99 era. We'd probably characterize it as 97, 98, but I think certainly what we're seeing is backlogs of these companies remain stellar. Earnings growth and revenue growth, by the way, still impressive but slowing. So that second derivative may start to matter more, we think, in the year ahead. And of course, what we're watching is these companies' business models are shifting a bit, a little bit more debt heavy, a little bit more asset heavy, going from asset light to asset heavy. And that could weigh on multiples valuations over time.
I was going to say, how much are you paying attention to some of the spreads? CoreWeave CDSs widened out yet again yesterday. Oracle maybe had a little bit of a better day. It was rallying in general after a Deutsche Bank note on some of the OpenAI benefit. But at what point do you say, maybe there's some stress in here that will impact the general AI economy that we're witnessing?
Yeah, and it's good call out. Look, I think the market is smart and has sniffed out the players that could potentially feel that stress. So we know companies like CoreWeave and Oracle weren't part of that kind of Magnificent Seven cohort that were so cash rich and can actually fund a lot of this AI spending using cash on the balance sheets. Now, a lot of those companies, think about Meta, Amazon, et cetera, are starting to tap the debt markets as well. So I think that's where we want to be a little bit more mindful that, yes, they are very cash rich, but their capital structure is shifting a bit.
I promised I would ask you about the small caps because they're down a little bit today. And they just really haven't had the win everyone expects. Even as we see, we've had like 1.25% rate cuts already, and we're looking to go down to maybe even less than 3 if you believe the world interest rate probabilities function on the Bloomberg. Shouldn't the small caps be benefiting in this environment?
Yeah, look, this is a year where you would think the small cap story would work because we're not only seeing Fed rate cuts, the earnings story is going from negative to positive in 2026. So there's an inflection point in earnings for the small cap space as well. And keep in mind, the larger weightings in small caps are sectors like financials, industrials, not so much tech heavy. All that being said, we remain overweight large and mid. We're not as favorable on small cap only because they tend to have more negative earners. They tend to have more leverage on their books and some of those zombie companies as well. So we think the way to play kind of that Fed rate cutting cycle might be in that mid cap space.
By the way, when you had the sell-off that was, I guess, driven by some of the AI names, some of the worries, small caps are really hurt too. A lot of corners of the market were hurt that have been big momentum names. Maybe that had to do with crypto, but has that been instructive for you, that sell-off that we saw the other week, and potential events like that to come for next year?
Yeah, look, I think a lot of us were thinking 55% rally off those April lows in the NASDAQ. So were we due for a little bit of a pullback, a little bit of a correction? Probably. And then we started layering in some of those other factors. Bitcoin was having a down day. The CDS in some of those names we talked about were starting to widen as well. But all that being said, it was a pretty short-lived correction, and it seems like we're back to the races as we head to year end and that potential Santa Claus rally ahead. We do think in order for there to be a sustainable move lower, there has to be some sort of shift in the narrative, and we just have not gotten that yet.
So what are the things that you're worried about? I mean, the labor market blowing out, inflation continuing to rise.
Yeah, it's a great call out. Our team is actually thinking about key risks for 2026. Probably the top 2 to 3 are the AI story slowing down in a more meaningful way than is anticipated by the markets. So looking at that second derivative, but do we get even a bigger shock or slowdown next year? Number 2 is inflation. Could we see an acceleration? And, we've been pretty contained thus far in this 2.5% to 3% inflation environment.
I wish 2.
Yeah,
more like 3.
2.5 to 3 is fair. Yeah. And I think, if we see an acceleration beyond that, the markets get worried, the Fed story comes into question. And the third one we'd highlight is in the credit space. And both public and private credit. Could something happen there that triggers volatility?
One of the more fascinating things is that, and I've heard a lot of these points be made before, everyone's skipping out on the politics. This time last year when Trump was elected, the thought was politics will drive the economy. Now the conversation is AI is driving the economy. Is that fair that we've kind of disregarded that of what's coming out of the White House as drivers for the market?
It's a good call out because earlier this year it was all about the policy, and specifically tariff policy, that was driving markets, driving volatility. As we head into 2026, it is a midterm election year, so we'll be watching that. It is a year where we'll have a Fed chair transition in May, and so we'll be watching that carefully as well. But more broadly, I think to your point, the AI story and really the economy and inflation story will probably be front and center for investors.
I mean, you did pick inflation as your number 2 concern.
Yeah.
That,
Yeah,
to
true.
be clear, is tariffs.
Yeah. No,
right?
it's true.
But I think that the surprise has to be AI. I mean, who expected, even though we saw the promise of like Chat GPT, for people to be using it this much? I saw figures this morning that 35 million people are paying for it, and those figures are from July. So that's got to be increasing, exponentially, because it's not just for writing reviews or, doing research at work, but it's also for like finding recipes, and, rearing children. Like people are using it for relationship advice.
Yes. Absolutely. And, look, I think as we think about the AI story evolving, there will be potentially winners and losers. And you guys were alluding to the, Nvidia versus other parts of the market, or we have the ChatGPT versus the Google platform. And so if there are a couple of winners that emerge, maybe there's pressure on the rest of the secondary and tertiary players in the market. The other part of the story is eventually investors are going to want to see productivity gains across sectors. And that is really the hope, and that is really the story, part of the story behind why you should be diversified in sectors like financial services or healthcare or industrials that can benefit from robotic manufacturing or efficiency from AI. And so I think we are hopeful that by the end of 2026, those gains start to emerge as well. And hopefully there's no surprises on that end.
I think we all hope that. Mona, thank you so much for joining us. Enjoy your Thanksgiving holiday. Mona Mahajan of Edward Jones. Let's get a check on the stock market right now, because Mona was mentioning the back and forth between Nvidia and Alphabet. It would turn out that Nvidia is winning today while Alphabet falls. Just looking in the plus column, maybe someone was listening to Dan Ives talk to Matt Miller and me about how he is still backing the company, and Jensen Huang fiercely defending against Michael Burry or putting out on X, congrats Google, but we are better. Those shares up 2%, that adds 10 points to the S&P 500. Meanwhile, a lot of the associated names, Microsoft, Oracle, they're doing better. Apple, that continuing to gain. On the downside, it's Alphabet that's the biggest detractor. Again, not because it's falling so much, only down 0.7, but just because of its weight. Deere is up there. Poor earnings. Workday also up there. Not so good earnings from the HR solution provider as well. Looking at the different sectors, again, this is going to be Alphabet down here, the communication services, the reason that's down by 1/3. But if you go all the way to the top, the tech index, that's Nvidia retaining its crown to the upside, again, more than 2%. And some of the utility names, I mean, you could argue that that's also an AI play this morning, Matt.
Yeah, very interesting to see, Google down.
Yeah.
Google is that communication services, and Nvidia is up there.
For sure.
And the story, the narrative, of course, has been the other way around. Alphabet, Google leading the pack as it takes on Nvidia's chips, and OpenAI's chatbots, which with its Gemini 3 platform. We'll discuss the shifting hierarchy among the Mag 7, even if the stocks are going in the opposite direction. This is Bloomberg Open Interest.
The best 3 days of gain since May will today make it a 4. We are up 0.5% for this equity market 15 minutes into your trading day. Let's look at some of the top calls, the analyst action that we are focusing in on. First up, Autodesk, that gets raised to a buy at Deutsche Bank after the company hiked its full year outlook. It topped the street estimates. The analysts there are calling it a very healthy quarter and, quote, one of the cleanest reports that we've seen in years. Next up, Deere shares, those are under pressure. The company's profit outlook came in a big miss, shares down 4%. Jeffrey says the results and forecasts line up with expectations for another year of American ag declines, and they're watching pricing and tariff mitigation closely. And finally, Oracle higher after Deutsche Bank said the stock still reflects little, if any, credit for its AI partnership. The analysts say that the math shows the market isn't valuing the business at all, even as demand tied to OpenAI grows, and those shares, Matt, up just under 5%.
Yeah, the AI hierarchy is seemingly getting reshuffled. Nvidia shares are down on the month as peers like Alphabet and Meta rebound. It's a sign investors are fearful of an AI bubble with too much concentration in Nvidia, as well as Nvidia's circular investments in startups like OpenAI that are also customers. Bloomberg Intelligence Global Head of Tech Research Mandeep Singh joins us to have the same conversation that we have every morning. The difference is now, like, Gemini 3 apparently is very good, and they are using their own chips to do that. Have you dabbled with these other platforms?
I have, and look, I applaud Anthropic for really keeping their focus on, the coding agent use case, because to me, that's how you differentiate in this race where multiple LLMs are converging, OpenAI, Gemini, and Anthropic continues to show that, yes, for coding agent tasks, companies will be willing to pay a premium for their product because their product is better in terms of, using the same task. So
now that's Anthropic. What about Gemini 3? What about Google's chatbot? What's it good at?
Well, so the thing about Google is, one, they've done very well with image generation and, just kind of coming up with anything to do with visual search or visual content. And that's where ChatGPT still is the most used kind of chatbot, text-based chatbot. People use it for audio. But I think where Google has really differentiated themselves is that video and video and image generation use case. And that in itself is a very big market. I mean, think of all the things we do in terms of image and videos. And that's where I think Meta using Google makes sense, because a lot of the recommendation algorithms on Instagram are very similar to what Google is doing on YouTube. So their ad stacks are similar. So even though one of the criticism I've heard is TPUs are very specific to Google. Well, Meta and Google's business is very similar when you think about, the videos and the ad stack. So from that perspective, it does make sense that Meta should be able to make use of the chips that Google is using.
When we're talking about advancements here, it still feels kind of incremental. I know in the grand scheme of things, I mean, we've come so far, but it's better video, maybe better recipes. We're not talking about like this promise of super intelligence. It feels like we're a long ways away from that. What is the risk that that's not where we're headed, or at least we're not going to get there for a while and things do start to plateau off?
I mean, superintelligence at this point of time is an abstract concept, because do you think superintelligence is constantly learning LLM that gets better at all these tasks? That's why I like to think in terms of tasks, that these models are very good in terms of bringing in an intelligence layer to a certain type of task, whether it's customer service or any other type of work that you're doing within an enterprise. But superintelligence to me is somebody who's good at everything. And that's where you can't be good at coding, you can't be good at customer service and image generation as a human being. So why would we be talking about superintelligence? I mean, maybe that's the end goal of OpenAI and all these models. But to me, that has to be a constantly learning thing, and maybe somebody is developing, an algorithm like that. But right now, it's driven by data and pattern recognition.
When are these things going to get truly agentic? Like, when can I say, I want to go on a trip to Southeast Asia in February for 7 days, find me the best plane tickets, and like, here's my credit card, go ahead. Or when can I say, I'm looking for a used Porsche, but I want it to be a manual transmission, not a PDK that pretends to be manual because they're paddles. You have to look through the pictures to verify the ad. Go ahead.
I mean, on the travel one, look at how many integrations you need to get all the right data to be able to, act as your travel agent. It's not that easy. You need to tie it to Booking, Expedia, the airlines.
It's not easy. That's why I want AI to do it for me.
But AI can't develop the connectors. It's the companies who have to agree that they are willing to give their data to OpenAI or Gemini, and then Gemini uses those integrations, feeds it to their LLM, and builds the product. There is no magic formula with AI in terms of building those connectors. The companies have to agree that they are willing to share their data, and that's how the connections get established.
By the way, on the other side of that, I'm assuming it's going to be Delta or United or whoever you're booking from. that you have your AI agent talking to their AI agent, being like, great. I wonder on the other side of things, on the corporate side, is that closer to realization?
I mean, think of how it changes your business completely. Right now, you have customers and clients who are coming directly to your brand. They associate your brand. Once you start giving your data to LLMs, your brand awareness is gone, your first-party interactions change completely. So that's why this stuff is hard. Even though the technology is there, I mean, you have to deal with existing systems, and a lot of them are critical systems that no one wants to change. And you have to build those connections.
This is getting really existential. Mandeep, thank you so much for joining. You can repeat this conversation on your Thanksgiving Day dinner. Mandeep Singh of Bloomberg Intelligence. Coming up on the show, Warner Brothers is asking for new sweetened offers for its assets by the end of the month. We're going to have the latest for you next on Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Happy Thanksgiving Eve. We're looking at stocks that are, for the most part, gaining. So the S&P 500 up 0.5% right now, powered higher by Nvidia in rebound mode. The Nasdaq as well, gaining 0.6%. Even the small caps now are up 0.4%. The gain on the Russell and the Dow Jones Industrial Average at 47,300. Take a look at what's going on in the individual movers. You've got Nvidia right now up 1.25%, and Google actually down 0.4%. But if you look over the last week or the last month, they're a mirror image of that. Dell right now up 2.5%, and HP down 2.5% on earnings. HP also saying that it's going to cut jobs, I think 6,000 to 8,000, but through 2028, so for like the rest of eternity. Paramount Skydance right now up, and Warner Brothers up a little more at a gain of 3%. I'm not sure if that's motivated by their ask, but they do want more money, and that's what we're going to talk about right now.
We are, and let's bring in Bloomberg's Hannah Miller, who has been tracking the saga for more on Warner Brothers Discovery. Hannah, I guess because they have 3 bidders at this point, they can afford to ask for sweeteners, right, and push back on what they have.
Yeah, it's going to be a really busy Thanksgiving weekend for these bankers.
Oh, yeah, I feel bad for the bankers.
Oh, yeah.
Don't feel too bad.
But yeah, no, they have some flexibility here. They can ask for more money. Again, any bidder has to explain why there won't be antitrust concerns, or if there will be minimal antitrust concerns with their bid. So, you know, there's still some flexibility here. We are expecting a final decision towards the end of the year, maybe around Christmas time. So this is just one step closer to that.
What are the crown jewels of this company? Like, what do people really want, and what are they going to, peel off and throw away?
Yeah, so streaming and studios, those are the crown jewels. And we have Netflix and Comcast going for that. The difference with Paramount is that they're going for the whole company. They're going for those cable channels as well. So that is what sets their bid apart from the other two.
Does it make a difference to Warner Brothers whether someone buys them outright or buys pieces?
You know, they are going through their own separation right now. At the end of the day, they're going to look at, what brings the most value to shareholders. CEO David Zaslav is also very interested in what his role is going to be with whatever shakes out. So, it could be anybody at this point. And
one, I would guess, has a better chance at clearing FTC hurdles or antitrust issues, right? Because Paramount Skydance, they're much closer to the Trump administration.
Yeah, the David Ellison, who's the CEO of Paramount, he has spoken about the good relationship that he has with President Trump. And, the big thing going for Netflix against their bid is the concern that their streaming services combined with HBO Max would be too much. It would trigger antitrust concerns.
All right, Hannah, thanks very much. Bloomberg's Hannah Miller. We're back with another hour of Open Interest. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Nvidia heading higher again today, allowing this index to be on track for a 4th day of gains.
Coming up, investors rethink a post-Powell Federal Reserve as President Trump ally Kevin Hassett becomes the top contender to take that seat.
Consumers show signs of fatigue ahead of the holidays. We get a read from the CEO of Stu Leonard himself.
I'm very much looking forward to that. Uncertainty hits Deere. Shares fall on a disappointing outlook as a recovery in the farm economy remains elusive. And I'm not wearing glasses also. Actually, I just wanted to point out one time.
Yeah.
This is the first time I've ever worn contact lenses in my life, and it is awesome.
Do you need to point that out because you think viewers are watching and are like, who is that man? I don't see glasses. I'm confused.
It's a feeling of liberation that I haven't had since April, you know?
I'm so happy we're having this conversation.
All right, let's get back to business. U.S. consumer sentiment is sitting near record lows, but that may not last long, according to our next guest. Ecofi Investments portfolio manager Karen Georges says there will likely be, quote, a more pronounced slowdown in Q4 than the market anticipates, but a pickup in the beginning of 2026. Karen joins us now, as well as Bloomberg economist Stuart Paul. Welcome to both of you. Thank you so much for joining us on this pre-Thanksgiving day, although, Karen, to you it probably means a little bit less, but I'm sure you get the spirit of it. How is the U.S. consumer going to fare over this long holiday weekend? Because we see 42 million Americans on food stamps. We see more subprime auto defaults than we've seen since record-keeping began in the 90s. We see, this struggling consumer hand-in confidence survey numbers that are disappointing on every level. How's it going to be?
Well, first of all, thank you for having me. So hello, everyone. So Matt, I have glasses. I know you don't, but I have some. So okay. So thank you for having me, both of you, Dani and Matt. And so first on the American consumer. So our scenario is not like something of sharp drop off. So the consumer should still be cautious, but nothing very dramatic. So we don't anticipate, when we look at data on goods, even though data has been scarce since the shutdown, we don't see a sharp slowdown. That will probably still be the case. There's an American company that all of you know in the US called J.M. Smucker that said yesterday that they would sacrifice pricing in order to keep a higher demand for coffee. So we see companies being more flexible for there to be maybe a higher demand going forward. So our scenario is like a pursuit of the slowdown in the consumer environment in the US, but without a sharp drop-off. And at the beginning of 2026, maybe a rebound that could be maybe higher than what other people anticipate. And that's why we have maybe a different view on the Fed than the consensus.
I wonder how that plays into your investment decisions, Karen, because I was speaking with Mona earlier about this, that consumer stocks have been so beaten up. I mean, they're still up on the year, but vastly underperforming. Discretionary only up 3%, staples up 2.4%, with an S&P that's up more than 15%. Does that mean some of those unloved, more consumer-oriented parts of the market could also rebound to start next year?
Well, as you know, timing is everything, and probably they'll have a cautious tone at the beginning of the year when you have, the results period. So probably safer to wait a bit to have maybe a clearer view, especially on tariffs, because the academic data has shown us that usually there is a lag of 1 or 2 at least quarters between the beginning of political uncertainty and the tariff that we had in April, and the fact that we see it in real hard data. So probably we'll know more during the next period of results. So there might be a bit of a lag. So a bit of cautiousness still in the beginning of the year. That's our scenario.
Stu, what's your take on the Federal Reserve and the terminal rate that we're seeing? On the Bloomberg terminal, it shows interest rates getting below 3%. But even the sort of Trumpiest of guests that we have doesn't think that it's going to get that low. Okay, Myron does. But most people are saying like 3.25% at most. Why is the market pricing in so many cuts?
Look, I wouldn't even be surprised to see us getting down to 2.75 as the top end for the federal funds rate target range. I think that most people are concerned about the idea that the Fed cannot abandon its 2% inflation target. But I think the reality is that, as Karen was saying, firms are hesitating to pass on price increases to their consumers so that they can sustain a bit of demand. If that's the case, I think that we can see inflation coming down just a little bit, albeit very slowly. And if that's the case with a dovish FOMC, I think that we can get to a 3% or even a 2.75 terminal rate. So we also need to keep in mind that it's not just going to be the chairman who makes it to the board. If we see Chairman Powell resign his governorship upon the expiration of his chairmanship in May, President Trump's going to have another opportunity to put another dove on the board. And so I think that we can get to a terminal rate that the market's pricing in, even though some folks might be hesitant to say less inflation expectations.
Even with unemployment at 4.4, maybe 4.5%, as inflation hangs 50% above the Fed's target, you think they're going to keep cutting?
It's 1 percentage point above the Fed's target. Let's keep that in mind.
Dude,
and
if I told you I'm going to pay you $200,000 next year, but then I give you $300,000, I mean, aren't you exceedingly happy about that? It's a huge difference.
When we talk about percentage difference in percentage points, we're starting to get a little bit, out of our element here. But I think the thing to keep in mind is that the experience of consumers is just 1 percentage point of additional inflation above the Fed's target, not 50% more inflation, right? It's a difference that's meaningful to make. I think that the thing to keep in mind is that the balance of risks is still skewed towards labor market deterioration and then spending deterioration. If the Fed continues in its easing track, it can sustain an expansion, and balancing those risks is what's most important rather than really muscling inflation that last mile to 2%.
So, Karen, just taking this all into conversation, because we add to this, as Stuart's also been talking to us about today, a more dovish chair at the Fed. How much or how many cuts are you assuming into your more bullish outlook for next year? And if you do get more cuts, just how much does that juice a stock market versus juicing inflation and causing more headaches?
Well, I'm going to disappoint you. I differ a little bit from Stuart. So we are quite different from the consensus. We don't anticipate a cut in December. I think it's about 80% that anticipates a cut. Our scenario is maybe a bump in inflation that can be maybe less as high as that we thought like a few months ago, but that's going to be longer in terms of inflation being sticky for longer. And the employment market is going to be tough for a couple of months, but we anticipate that it's going to be better next year. So that's not really good for inflation. So we anticipate one or at least maximum 2 cuts for the next year for the Fed. So even if it doesn't cut in December, they would cut in January. So if that happens in December and we are correct, the market won't like it. But at least it means in a different way that the American economy is more resilient than what the market thought. So it depends which part that you keep in mind, higher inflation or a better U.S. economy. So we think the second part will persist, though, and I'm not biased when I say this, we still anticipate the rest of the world beating the U.S. market next year in terms of diversification. So that's our scenario at Ecofi.
I wanted to go there anyway, and I wanted to pivot so that I can get Stuart's take on the all-important UK autumn budget. But in terms of rest of the world investments, we have seen amazing outperformance all year long from Europe and many other regions. Not that the U.S. has done poorly, and obviously we had a really good 2024 and 2023. But why do you think that continues when we hear about 0% growth in the UK or 7 different prime ministers in France? Like, how does that growth continue in a place that has no real AI investment?
Well, for the A part, you are correct. I think the AI is around 45% of indexes, at least for the S&P in the US, and AI exposure is around maybe 10% for the Eurozone. So we have less exposure to AI into, of course, high growth stocks. However, we think that growth will surprise positively in the Eurozone, mainly, maybe less in the UK, but more the Eurozone. And that should provide upside for the Eurozone. And valuations are really disconnected from what we see for the US. And we anticipate that growth will be at least low double digits for the Eurozone in terms of EPS for next year. So that's pretty okay. And it does deserve at least a reduction of the gap between the two countries, the Eurozone, and the US. So we don't expect the political situation to at least to remove additional growth for the Eurozone for 2026. And the UK valuations are even cheaper than the Eurozone, and we've seen a lot of M&A activity in the UK market, so that should be also maybe a boost for next year.
Well, now I feel bound because I can't do anything except ask Stuart about the UK.
So, you can ask Karen another question, then we'll get to Stuart about... Look, everybody wants to talk about the Chancellor of the Exchequer.
Well, first of all, because there was insane drama around it. You get an early release that sinks markets. But like
gaping funding hole of almost $25 billion.
I know where you're going to go with this, that 20 billion pounds is not a lot. But if I can just take Karen's point, Stuart, and bring it to you, it was supposed to be this moment where the rest of the world, especially Europe, saw this fantastic era of growth because they needed to invest, especially in their military. They needed to get energy independent. A UK OBR puts out a forecast that I think it was like 0.1% of GDP growth they see. It's anemic, and it was supposed to be something that would be beating or at least make it more attractive than American assets.
Well, look, I mean, the rotation away from American assets has been in part because of expectations of stimulus basically elsewhere. Even when we look at the UK's proposal and some of their assumptions about growth and efficiency gains, we still think that the growth forecasts and efficiency forecasts, productivity forecasts, are still overstating what we think is most likely. We expect productivity growth of about 0.5% over the medium term for the UK, no matter what the OBR is actually baking in. I think that when we think about the rotation away from the U.S., we also have to keep in mind that there's just been a shifting of the global commercial order. It's not just fiscal stimulus in Europe that's helping to drive any sort of rotation here.
All right, Stuart, great having you on set with us. Stuart Paul there from Bloomberg Economics. Karen Georges from Ecofi. Really appreciate your time, and I hope you have a wonderful Thanksgiving as well. Let's get a check on the markets right now. We're looking at gains of almost 0.5% on the S&P and the NASDAQ. The Russell and the Dow are up as well. You can see the 10-year yield rising a little bit now, 3.5 basis points, as it had gotten down to 4 flat. And let's get a look at some of the individual movers in this market as well.
Let's do it, because we're looking at Urban Outfitters posting strong sales last quarter. Apparently it leaned into college campuses, campaigns with campuses and student athletes, because you can do that now with student athletes. Those shares up nearly 13%.
Zscaler is falling despite raising 2026 guidance, with investors setting a high bar for the cybersecurity stock, so the company getting more than decimated today.
And also to the downside, HP's profit outlook missing estimates for the year, memory chip costs weighing on the company. It also announced between 4,000 and 6,000 employee cuts, job cuts through fiscal 2028. I don't know, Matt. They're blaming AI tools, but come on.
Yeah.
Come on. That can't be the reason.
I'm with you on that. Come on.
Come on.
Coming up, another stock we are watching today is Deere. Nothing to smile about here. It's down 3% after delivering a very weak 2026 profit outlook. We'll look at the world's biggest farm machinery maker and what is the problem next. This is Open Interest. Let's get to high interest now. Look at what's making headlines around the world. U.S. envoy Steve Witkoff will travel to Moscow next week for talks with senior Russian officials. A trip to the Kremlin, or that the Kremlin says, I should say, could include a meeting with Russia's Vladimir Putin. It's part of President Trump's push to strike a Ukraine peace deal after nearly 4 years of war. But despite U.S. optimism, European allies remain doubtful, arguing Putin has no interest in an immediate ceasefire. New York City Comptroller Brad Lander is urging 3 of the city's pension funds to cut ties with BlackRock, saying the firm's climate strategy isn't strong enough and puts retiree assets at risk. BlackRock, which manages over $42 billion in index funds for the city, pushed back, calling Lander's claims political and misleading. His proposal now heads to pension trustees and could be one of his final moves before leaving office in just a few weeks. Deere is bracing for another tough year on the farm. The world's biggest tractor maker issued a weak 2026 outlook, underscoring how little visibility there is on a rebound for U.S. ag, as tariffs, trade, uncertainty, and soft crop prices keep farmers on edge. Analysts say the guidance signals a deeper, longer downturn, even as a new U.S.-China trade deal and promised federal aid have yet to deliver a real pickup in demand.
For more on Deere, we are now joined by the Boston Bureau Chief and writer of the Industrial Strength newsletter. It is Brooke Sutherland. Brooke, great to see you. I think there were expectations, right, that Deere wouldn't be strong. So why is it even weaker with already expectations so low, given just the strength of, or lack of strength, of farmers right now?
I mean, it was interesting to see Deere call a bottom for the large ag market in 2026. And so I think that does align in some ways with, what investors and analysts were looking for, that at some point the worst is going to be behind us for what has really been a fairly deep downturn in the agricultural equipment segment. But I think the guidance and the weakness of it just really underscores how hard it is to call precisely when that bottom might hit or just how deep it might end up being. And I think there's still a lot of ambiguity about, China's purchases of U.S. crops and what exactly that's going to look like, even though we do have a framework of an agreement between the U.S. and China as part of that deal to curb some of the tariffs. There's been a lot of talk about aid to farmers, but the parameters of that are still very unclear, and it's not, it's not yet clear whether or not that's going to be any more than just a temporary Band-Aid for the farm sectors. And so I think if you're a farmer and you're thinking about making what is, a fairly substantive investment, there's still a lot of questions out there, and you're not quite ready to jump back into that market and make some of these purchases.
Hey, Brooke, I realize its biggest business is in tractors, but we just saw some promotional video from John Deere, and they've got bulldozers moving big stuff around as well in a very Cat-like way. And Cat has become kind of an AI play because they're helping to build data centers. Isn't some of Deere's equipment used for the same kind of thing?
They're used in they do have a construction segment. And I do think it was encouraging to see, a positive revenue outlook for that part of Deere's business for 2026, because this business has also been under pressure. I mean, I think if you sort of zoom out, we are seeing a ton of construction related to AI and data centers and all of the equipment that goes into supplying those data centers. We're not seeing very much robust activity in other parts of the construction sector. And so if you look at some of these companies that you've actually not seen, the boom in their sales that you might have expected just because of that weakness elsewhere in the construction economy. So it is encouraging to see Deere have a more positive outlook for that segment going into 2026.
And to be fair, there's been a lot of enterprising agriculture industry executives who've been trying to incorporate AI in there. Brooke, just how big of a business is it for Deere, not just in the construction sector, but in agriculture too?
I think, Deere talks about it in a way that it could be a real game changer for their business. I mean, in terms of really increasing the technology that's, infused into their equipment, making it more precise, more effective. And so then if you are a farmer and you're making these large investments, you're getting more bang for your buck. You know that these machines are going to be more precise and really target what you need them to do. And so this is very much an opportunity for Deere. It's still somewhat hard to quantify exactly what that looks like for the company, but this is certainly a growth avenue and one that they're pursuing very aggressively.
How much AI is Deere using in its own product offering? I mean, it's not just about tractors, right? It's about the software that they need to run those tractors. They're obviously very autonomous, so that farmers need fewer laborers to do the work.
Yes, I mean, I think that's definitely important to the company, as it is to many industrial equipment manufacturers. I mean, you're really seeing sort of the beginnings of companies figuring out how they deploy this. And what you hear from a lot of companies is, we've talked about predictive maintenance, for example, for years, but I guess it wasn't really that predictive because you ended up having to do a lot of work to sort of line up the data and get the analysis and the insights that you were really looking for. And the way that AI can accelerate that, it makes a big difference. And so I think you're seeing companies start to, experiment and see what's really possible with AI to really enhance the software offerings. I mean, I think one of the things that we learned during the pandemic supply chain crisis is just how many different pieces of equipment require chips these days, which just shows you, how much technology is already infused into these industrial equipment products. But that's only going to accelerate with AI, and you're really at the tip of the iceberg on that.
Brooke, thank you very much for that update. That is Bloomberg's Brooke Sutherland on a day of Deere's earnings reports. Share still down 2%. Still ahead on this show, Stu Leonard Jr. talks food costs and margins, with consumers getting more picky about spending and the spending they're doing on some delicious turkeys. There they are before and after, I guess. That's a little depressing. Anyway, that conversation to come on Bloomberg Open Interest.
Going to check on the stock market right now. We're looking at gains on this pre-Thanksgiving day. And you can see here that we've hovered around this level all morning, about 1/3%. This is the move screen, by the way, the most dynamic way to look at any index. It's interesting because we see the reverse today of what we had yesterday and the last couple of days. Nvidia is climbing right now, rebounding from a near 14% drop this month through yesterday's close. And you also have other tech stocks gaining. Microsoft up, Oracle, Broadcom, Apple, Netflix, AMD. On the downside, you have Google. And this had been the big gainers. These are the AMC shares. You can see both taking points off of the index, about 7 points combined. On the downside, Intuit, AbbVie, Salesforce, and Lilly. Let's take a look at the sector breakdown. On the Bloomberg, you have to type in SPXL1 index. GRR to make it just 11. Materials now leading the way. You've got utilities and energy doing well, as well as consumer staples. This is interesting because this is fairly defensive, and maybe that's what investors want to be holding going into the long weekend. On the downside, you have communications services, and that is the hyperscalers. Coming up, we're going to talk affordability. This is Bloomberg.
Prices are up across the board, and so many things have been affecting this. Clearly, yes, we're talking about beef, poultry prices, all of those ingredient costs, food, supply, even on supply side, packaging. We also are facing increases of produce. People are definitely drinking less. I think we're down about 20% in terms of what the public is consuming in terms of alcohol.
That was Carolyn Stein of the Loot Group. Joining us now is a unique guest. He not only runs a grocery store, but also a wine store, prepares hot food inside of his grocery stores. You can go there to eat outside as well. I get my Christmas trees there. We're talking about Stu Leonard's. We welcome Stu Leonard Jr., the CEO of the grocery chain. Stu, let's talk first about affordability. I know that the USDA has said turkey prices are up like 40% over last year. How are you able to give customers a meal they can afford?
Well, Matt, first of all, thanks for shopping at Stu's. I appreciate it. I know you're a customer. Our turkey price is the same as last year. The other retailers that I've talked to, their prices are pretty much the same. I don't know where this 40% came from. Somebody picked that number out there. I would say right now, the mood of everybody in here, I just talked to a customer a minute ago and asked her, and she said, I feel the pressure right now at the holidays. It feels like it's a little more expensive. There's a lot of things that go into it. Your guest before mentioned packaging. Labor is another big cost. Our energy costs now, kilowatt hours are up 30% for us. These are all pressures. We're just a family business here, and we're just we're on razor thin profit margins in the food business. We don't want to raise prices. Our prices at Stu Leonard's are the same as the last year if you were going to buy your Thanksgiving meal.
For Thanksgiving, Stu, it feels like people kind of go crazy in trying to figure out what turkey they want. I come from a family where I've had family members who will drive out to a farm because it's like this organic turkey that gets massages every Wednesday or whatever and makes it delicious.
Yeah.
It's a moment in time where people are obsessed with avoiding ultra-processed foods. Are things like organic, is that still important when people are buying a turkey? And are they still willing to pay up for the most premium offering?
Well, you know what? Look, most of the animals that we consume, it's what they eat. So one of the things about organic is the food is very regimented. There's no hormones added. There's no antibiotics ever used. They usually will be outside free range. So an organic turkey probably is the best, but you're going to pay for it. So we have at Stu Leonard's, we found a great turkey farm down in Pennsylvania, Jandel. We've been dealing with them for 30 years now. They've won all these awards for their breed. And they're free range. You see them outside right there. They're able to walk out and eat their diet from the grass, which is giving it great flavor. The other thing that's important, you can buy the best turkey in the world, but if you screw up on cooking it, okay, it doesn't matter what turkey, it's going to be dry. So you want to make sure you prep it really good. And if you want a little secret, Martha Stewart told me this. I asked her about the best way to do turkey. She slides a little butter under the skin. Okay, is that cheating? But boy, what doesn't give great flavor to a turkey than butter?
One of the things I do is, Stu, I used to always stock up on my IPA beers when I was stopping by your Yonkers store. No longer do I drink the alcohol, but I'll pick up a can of Cycling Frog, and that makes everything taste better. Do you see that trend among others?
Hey, Matt, that's a huge trend right now and very controversial because, we're able to sell right now those sparkling waters with 5 milligrams of THC, and that law's changed right now. So there's pressure on this whole THC-infused drink pressure, but it's exploding. And I think most people, instead of having maybe 2 martinis tomorrow at Thanksgiving, they might just have one because they got to drive and they'll have maybe a can of Cycling Frog, with THC in it.
Hey, Stu, I would also love to get your take on white label products versus the brand labels, because we've had earnings from some of the big brands. They have varied as to whether or not they've done well. What are you seeing at Stu Leonard's and what people are buying?
Well, that's a great thing. There is a shift to private label right now. As long as you have quality, and we're about 75% private label. Trader Joe's is hugely private label. You can see there's a lot of private label at Costco and many other stores. So, some people can get the manufacturer of the national brand the private label for. And we do that a lot, too. So you can save 20% on your bill if you buy private label or white label, like you mentioned. The other thing you can do, here's another little secret. Ask your guests to bring some food over to your house. That'll lower your cost at your home. The other thing is try to cook it and prep it yourself at home rather than have our chefs at Stu Leonard do all the prep and put it together. Makes it easier for you, but it's time that you have to spend money in the kitchen like that. And the last thing I'd say to save money is we have a lot of demos going on today at the store. Stay away from them because usually our sales double or triple. And you put that one more item in your shopping cart, that's going to increase your food bill. So stick to your shopping list, stay away from impulse items, and stay away from the demo.
I'm going to go ahead and refuse your advice on that, Stu. I'm going to taste every one of the demos that I find there. I got to ask you about the competition. You have a Lidl supermarkets moved into the U.S. Aldi already here. I'm noticing more and more. We did have a DeCicco's closed down. However you pronounce that.
DeCicco.
Whatever. How is the competition for you guys right now? Is it heating up?
Hey, you know what? I don't know of a business. I get a lot of young people coming in. They're thinking of going into this industry. They're all competitive. Okay, you want to get into AI today, very competitive. So I grew up in the competition. Whole Foods did not exist when we began our journey. We've been doing this 100 years now at Stu Leonard. I think competition is good for you. You don't like it, but it's good for you. Makes you improve, makes you get better. I mean, yesterday we have a turkey dinner for 8 here at the store, and we compared that with one of our major competitors out there. We have to be better. We have to be fresher. It has to have better cooking instructions. So competition makes you better. Lidl, Aldi is opening. We have the Chicos. Costco's are opening up around us. Wegmans just opened up in Connecticut right near us. They're great family chain. So you live with competition and you just fight to do a little better every day.
Stu, before we go, who's your friend?
This is my little buddy. Okay, I do these tours for the kids through the store, and this is my little lobster show. I tell them, this is my friend Charlie, and I got to pet him like that, and they love it. And then I usually will take these pinchers, don't really bother you that much,
Right.
And I'll put my car keys in there or my something, and the kids will be able to hold it. But that's a nice big jumbo lobster. Hey, by the way, this price is the same as last year. And then here's another good one.
Oh,
hey,
yeah.
Matt, okay, that's a big tomahawk steak right now. Our ranchers come back from the Midwest, and this is what they want is a tomahawk steak. And you know what? Here's a couple things that went down. Obviously, eggs are down about $1 a dozen right now. Another thing that's down, huge amount of butter is being used today and tomorrow in the country right now. That's down $1. Hey, you know what's up? Coffee. Coffee's up, but there's a drought in Colombia. It doesn't have anything to do with their cost so much, but Trump just relaxed the tariff on that, so you should see coffee prices coming down.
Hey, Stu, I just want to say
there's good news.
we've got a producer writing in saying, pardon that lobster. Will you be pardoning your jumbo lobster friend there?
Hey, you know what? We have Senator Blumenthal coming in about an hour to pardon one of our turkeys, and we named it Butter Cone. And the reason is there's a trend on TikTok. We posted it. 18,000 people watched us make this. You know how you get an ice cream cone that's dipped in chocolate? Okay, this one's dipped in butter. Okay?
Wow.
And you put a little bit of salt on the top of it. So I'm going to have the senator taste this cone in about an hour or so and see what it's like. But you know what?
I hope.
It's like a crispy, crunchy outside, really smooth, great ice cream. The salt gives it a little bit of a tang to it. You got to try a butter ice cream.
I hope you don't regret that. I hope your cholesterol is in good shape, and Senator Blumenthal as well.
I was going to say, between that and the tomahawk, I'm ready for my arteries to be absolutely destroyed, Stu. Thank you so much for joining us. Always a true pleasure. Enjoy your Thanksgiving, Stu Leonard of Stu Leonard.
Thank you very much.
All right, now on a similar note, but maybe a more serious one. U.S. airlines are preparing for the busiest Thanksgiving travel period on record. Inclement weather will also be a challenge as the airline industry finds its footing after the record-long government shutdown. For more, we're joined by Bloomberg Airlines reporter, who I can promise you is not holding a lobster. It is Sri Taylor. Sri, is this an airline industry that is prepared for the busy Thanksgiving travel schedule after the longest government shutdown on record?
Right. Thanks for having me, Dani. I mean, the biggest issue right now is the lack of margin. So airlines have added capacity again to meet the holiday demand, but staffing, especially air traffic control, hasn't fully yet recovered since the government shut down. And then you add in the winter storms and scattered tech outages and even fuel constraints like we saw in Seattle. And you have an aviation network that's kind of operating right at the edge.
What about prices? How do prices look right now, Sri?
Prices are still good, but demand is still there. So airlines are recovering in that way. Fuel is also right at where it usually is. So prices are fine. We're still kind of seeing that same demand from travelers. As we can see, it's been at a record. This is going to be the busiest Thanksgiving travel period on record. Airlines are forecasting more than 31 million passengers from November 21st before Thanksgiving through December 1st when people are coming back. So the demand is still there and prices are matching that.
All right, Sri Taylor checking in on the airlines for us. Really appreciate it. Have a happy Thanksgiving. Coming up, Tesla made them trendy. Now electric doors are trapping drivers as triggering a safety crackdown. We'll have more in our big take next. This is Bloomberg Open Interest. In today's Big Take, we are exploring a design trend that was supposed to look slick and futuristic, but instead it's apparently trapping people inside of their own cars. Electric door handles, popularized by Tesla, but started by the Chevy Corvette, have been copied across the industry and are failing when batteries die or after crashes, leaving drivers, kids, pets, and one-time me stranded. Complaints are surging, regulators are circling, and automakers are scrambling for fixes. Bloomberg's global editor for autos, Craig Trudell, joins us for more on this story. Craig, I will say I got stuck in a C8 Corvette just for a panicked minute because the power went out and the button wasn't working. I eventually was pointed to a mechanical latch on the floor by one of the guys in the parking garage, but it can happen in any of these cars, and there are more and more of them.
Yeah, that's exactly right, Matt. And I think, the big concern, particularly with the electric vehicles, as you point out, this is not, specific or only an issue with electric vehicles, but in the event that you are in an electric car that has a high voltage battery and you by chance happen to have just been in a crash, that's where this gets really scary, right? It's of course inconvenient and perhaps sort of leads you to panic a little bit if you're in, say, a Corvette or a car that doesn't have a great big battery beneath you. But that's where I think we really sort of got interested in this trend, in that Tesla and other EV makers like Rivian that have moved to this design, and we have also established car brands like Ford that have a similar look to their doors. That's where it's really concerning if you can't get out in a situation where a battery fire has started. It gets really to a harrowing and potentially even a deadly situation.
And slowly but surely, we are hearing from the car makers who have these doors. Tesla had spoken to Matt and his co-anchor on the Hot Pursuit podcast, Hannah Elliott, about this, about changes they would make to the design. Are other car companies starting to think about changes off the back of this reporting too, Craig?
Yeah, I think in general, along the lines of what, Tesla told Hannah and Matt, is that they want to sort of try and move these handles to a situation where, ideally you have a sort of mechanical backup and that uses the same sort of means by which you get out of a car in a normal situation when you do have battery power. Or, just a matter of the simple act of sort of, making it more obvious and clear where these mechanical releases are. Matt mentioned the example on the Corvette being on the floor. In today's story, we mentioned that Chevy has just made it much more clear and put a sort of, little indicator on the floor. I do think that, one of the challenges you have here, too, if you think about, again, a crash scenario, is one of the things that tends to get in the way if you've gotten into a serious accident in particular is your airbag goes off, right? And so if you're looking around, digging around for how to get out of your vehicle and you have to have line of sight, if you have this great big airbag in your face, that makes things all the more complicated and difficult as well. So this is something that I think manufacturers are having to think of, and also that regulators are going to have to consider. And we're seeing, I think, China being the sort of most responsive to this, and potentially putting into place a ban on flush door handles in the months to come that would go into effect in the coming years.
All right, Craig, great to talk with you today. We hope you have a happy Thanksgiving, even out there in Blighty. Craig Trudell is our global auto czar. Tune in, by the way, to my absolutely fantastic podcast, Hot Pursuit, with Hannah Elliott. You get all the stories on the latest car news, our thoughts on each of them, and if you're searching for it on Bloomberg, on Apple, on Spotify, you have to search Bloomberg Hot Pursuit. Because there's apparently another podcast called Hot Pursuit that's just about Middle Eastern politics.
I'm saying it's no way it's nearly even a quarter of as good as yours.
No. Definitely listen to that. We'll be back. This is Open Interest. More Americans are opting for a different kind of buzz to go with food and family this Thanksgiving, as state laws around cannabis have loosened. It's spread into everything, including your holiday dinner.
More Americans are opting for a different kind of buzz this holiday season. As state laws around cannabis and other drugs have eased up, it's spread into everything, including the holiday dinner table.
It's more accepted. It is becoming more normalized.
Cannabis's newfound place at family functions speaks to how far the category has come. The move fits the lifestyle of people who describe themselves as California sober, abstaining from or barely touching alcohol, but open to substances like cannabis or psilocybin. Alcohol consumption has fallen to its lowest level in decades, according to a recent Gallup poll. Over half of respondents to a recent Bloomberg Intelligence survey said they now substitute cannabis for alcohol at least weekly. That might take the form of gummies, extracts, and even infused seltzers. Cannabis on Thanksgiving is a quiet tradition for some. The day before Thanksgiving is the second biggest sales day of the year for the US legal cannabis industry, behind only April 20th, or 420, which is the de facto holiday for cannabis celebration. The industry was valued at just over $30 billion last year, according to industry estimates. The cannabis market tracker BDSA forecasts growth in the total market this year of 4% to $31.6 billion. It expects the market to reach $39.1 billion by 2029. For the big Thanksgiving meal, some chefs are getting experimental. Miguel Trinidad, a New York-based chef and founder of the cannabis dining club 99th Floor, is infusing THC into his Thanksgiving menu.
Our mission statement at 99th Floor is to destigmatize cannabis through the language of food. The way I do that is by micro-infusions. What I'm making today is going to be a rack of lamb.
Trinidad infuses lamb fat in clarified butter with cannabis flour before sealing and cooking the lamb sous vide, a slow water bath method that keeps the meat tender and evenly cooked. He then finishes it off in a scalding hot pan.
So here you have it, the infused rack of lamb. It's 5 milligrams of THC. Over the course of time that I've been doing 99th Floor, things have changed. There's a lot of people that are coming out of the cannabis closet. It's something that's becoming normalized, and people are starting to understand it and respect it more.
While a few dozen states have legalized cannabis, it's still considered a Schedule I drug, putting it in the same category as heroin and LSD. Uncertainty at the federal level looms large, limiting access to banking, investment, and broader legitimacy. In August, President Donald Trump said he was considering reclassifying cannabis as a less dangerous drug, but no announcement has followed. The divide between state legalization and federal prohibition remains one of the biggest hurdles for an industry still finding its footing. In the meantime, the cultural shift is making its way into some holiday dinners.
All right, well, that's probably not how anybody's going to do it.
Eat lamb infused or whatever.
That's not how it goes. But it was interesting, I guess.
Yes, of course.
Have a great Thanksgiving. Good luck on the Cousins Walk. I'm sure it'll be different and better and more exciting than that. Bloomberg Tech is up next. This has been Open Interest.